can I show you a video from the United Kingdom on the Foreign Account Tax Compliance Act. It's a very short video, and it was done before they were able to sign an IGA. So, Manisha, please.
Hi there, I'm Nolan Taylor.
And I'm Evelyn Coe.
And welcome to this short program about the Foreign Account Tax Compliance Act, or FATCA for short. This program is intended to raise your awareness of the impending implementation of FATCA on the date showing on screen now. And it's important for you to realize up front that FATCA is going to be a challenging piece of legislation for us to implement, which is going to require a lot of effort and support from different areas. In this presentation, we'll address the following key questions. Effectively, FATCA functions on the assumption that all foreign financial institutions will, in fact, enter into an agreement with the IRS, since the costs of not complying with FATCA are likely to be simply too great. And we, unsurprisingly, have made a strategic decision to participate.
Yes, well, following our decision to participate, we'll be undertaking a quite significant operational program to get ready for FATCA, and depending on who you are and what business or function you work in, your support might be required from across a wide range of required activity. The first and most pressing aspect of implementation is for an FFI to identify which of its existing clients are going to be affected by FATCA, which isn't a straightforward thing to do, since FATCA-affected relationships aren't confined to just people with US passports and companies incorporated in the US. Now, apart from the identification of affected relationships, we'll also need to adapt applications, systems, and work processes to facilitate a wide range of FATCA-required activities. And just stop for a moment and consider, from what we've learned so far, the sheer range of issues to be addressed. The ongoing monitoring of existing accounts and their ownership, transaction histories, and average balances in line with FATCA rules. Obtaining information from potentially affected clients where this is needed. Identifying during account opening all new accounts that may be affected by FATCA. Obtaining privacy waivers from all affected account holders so that account details can be reported to the IRS without breaching local privacy laws. Flagging recalcitrant accounts, identifying and withholding any US source income to these accounts, and calculating and deducting any withholding tax payable to the IRS on these accounts. And of course, developing appropriate trigger mechanisms and reporting systems to ensure that information on US accounts is reported in compliance with our FATCA agreement. Earlier on, I spoke with experts from our own FATCA program office about the headline challenges in this daunting list.
Yes, well, the contact details of the FATCA program office are showing on screen now. If you'd like any further information, whether it's specifically on how this will affect you and your business or function, or if it's simply of a more general nature, then you should get in touch. That completes this general awareness presentation. Thanks for watching.
Indicators of potential US status, of which if even just one applies, then the account will be treated as a US account, unless the account holder can provide evidence to the contrary. And Nolan and I will now outline these indicators with the benefit of a few examples.
Well, first up, meet Ronaldo. He works in Singapore and lives there much of the time. He trades very actively on the global markets using investment accounts in Tokyo and London. He presented a US passport when opening these accounts and gave his US residential address rather than his address in Singapore. Documentary evidence of US residency or citizenship, for example, Ronaldo's passport, and a US address linked to an account are both very strong indicators of US status. So, Ronaldo's accounts, if they have an average balance of more than $50,000, must be treated as US accounts in accordance with FATCA rules.
Ronaldo's case is pretty straightforward, but let's have a look now at Natalie. She's French and has a French passport to prove it. She lives and works in Paris with her husband Robert, who has a Swiss passport. Natalie and Robert hold a joint account in Paris. At account opening, they presented their passports and gave their Paris residential address. This information is all held on record by the account holding institution together with other details, including Robert's place of birth, which is given as Boston, Massachusetts. Natalie's and Robert's passports confirm that they are not US citizens, nor do they live in the US, nor is there a US address linked to their account. However, Robert was born in the US, and for FATCA purposes, this marks him out potentially as a person with US status. In theory, this means that the accounts he shares with Natalie could be treated as US accounts for FATCA, unless they prove otherwise. Now in practice, Robert, Natalie, and the institutions they bank with would have plenty of evidence in the form of passports and other records to demonstrate that the US connection is neither relevant nor current, and to therefore be able to confirm their accounts as being other than US accounts for FATCA purposes. But they need to collect that evidence and be ready to provide it.
Right. Next up, we have Reginald. Hey, Reg. Reginald is British-born and lives full-time in London. He has a number of accounts in the Cayman Islands, but has little to do with their day-to-day management, and did not give his London address when setting them up. Reg's Cayman accounts are in fact managed by his authorized intermediary, an attorney based in Miami. From his Miami offices, Reg's attorney issues regular monthly instructions for transfers to and from Reg's Cayman account. Reg is British through and through. However, his authorized intermediary is based in the US. His Cayman accounts are managed via instructions that have been issued in the US. And furthermore, only a P.O. box address has been recorded with the account opening information for his Cayman accounts. Under FATCA rules, these last 3 points are all indicators that Reginald's Cayman accounts might need to be treated as US accounts for FATCA purposes. The Cayman institutions holding Reginald's accounts may therefore need to request documents in addition to the ones they already have, as evidence to verify or disprove that his accounts should be treated as US accounts for FATCA purposes.
And remember, if a client fails to cooperate, for example, by failing to provide requested evidence or other assistance to FFIs who are trying to establish or disprove the US status of their account, then their accounts must be treated as recalcitrant accounts, with all the attendant withholding tax and financial penalty implications which that entails.
Let's move on now and look at accounts held by so-called artificial persons or entities, such as corporations and trusts. Which of your existing relationships with entities such as companies, trusts, and financial institutions are likely to be affected by FATCA? Let's look at some examples. We'll start with Alma Industries. It has significant operations in the US as well as in a number of other countries and is, in fact, already documented as a US taxpayer for purposes other than FATCA. So Alma Industries accounts are presumed to be US accounts for FATCA tax purposes as well. Very straightforward. Let's look now at the Borison Trust. Unlike Alma Industries, the Borison Trust isn't a US taxpayer. However, the trust was incorporated in the US, which means that it is presumed to be a US entity, and its accounts are presumed to be US accounts for FATCA purposes. Next up, what about Chalinex Limited? Chalinex isn't a US taxpayer and wasn't incorporated in the US. However, it is part owned by Alma Industries, which has a 15% holding. Since Chalinex is more than 10% owned by a US entity, then its accounts are presumed to be US accounts for FATCA purposes and must be treated and reported accordingly. Any entity that is neither a US taxpayer nor a US incorporated nor more than 10% US owned is, for FATCA purposes, accounts that have been verified as US accounts will be subject to IRS reporting. But sharing information about these accounts without the account holder's permission would be a breach of local privacy laws in most countries. So, FFIs will first need to obtain privacy waivers from their US clients before reporting can take place. However, sometimes it won't immediately be apparent whether an account is US owned or not. in which case an FFI may need to seek additional evidence from the clients linked to those assets to establish whether or not they count as US assets for FATCA purposes. And the affected clients have a time limit within which to provide any evidence an FFI has requested, either to verify or disprove their US status. If a client fails to cooperate by refusing to grant the necessary privacy waivers, or by failing to provide evidence within the agreed timescale, or by failing to disclose assets fully in their annual tax returns to the IRS, then the participating FFI must treat their accounts as recalcitrant accounts and must withhold US source payments from them, with those payments then being subject to a 30% withholding tax. Now, in theory, this agreement to participate in FATCA is optional rather than mandatory. An FFI could theoretically avoid FATCA rules altogether by ceasing to hold accounts for US clients or to trade in US securities. But the price of this non-participation is very significant, because apart from any business strategy implications, any FFI that doesn't enter into FATCA agreement with the IRS, and which isn't otherwise exempt from FATCA rules, is classified as non-participating FFI. And US source payments to non-participating FFIs are then subject to a 30% withholding tax, which is deducted and paid directly to the IRS. Effectively, FATCA functions on the assumption that all foreign financial institutions will, in fact, enter into an agreement with the IRS, since the costs of not complying with FATCA are likely to be simply too great.
Yes, well, assuming that your organization has decided to participate, it will be undertaking a quite significant operational program to get ready for FATCA. And depending on who you are and what business or function you work in, your support might be required from across a wide range of required activity. The first and most pressing aspect of implementation is for an FFI to identify which of its existing clients are going to be affected by FATCA, which isn't a straightforward thing to do, since FATCA-affected relationships aren't confined to just people with US passports and companies incorporated in the US. Now, apart from the identification of affected relationships, the FFI will need to adapt applications, systems, and work processes to facilitate a wide range of FATCA-required activities. And just stop for a moment and consider, from what we've learned so far, the sheer range of issues to be addressed. The ongoing monitoring of existing accounts and their ownership, transaction histories, and average balances in line with FATCA rules. Obtaining information from potentially affected clients where this is needed. Identifying during account opening all new accounts that may be affected by FATCA. Obtaining privacy waivers from all affected account holders so that account details can be reported to the IRS without breaching local privacy laws. Flagging recalcitrant accounts. Identifying and withholding any US source income to these accounts. And calculating and deducting any withholding tax payable to the IRS on these accounts. And of course, developing appropriate trigger mechanisms and reporting systems to ensure that information on US accounts is reported in compliance with their FATCA agreement.
Okay. Signing of the IGA Model 1A in July. Hopefully it will happen in July. Model 1A being we have a tax treaty with the US and that we have a law, Republic Act 10021 on tax sharing of information. That's why we opted to go model IGA Model 1A. Okay. Now for the welcome message. Good morning. This gathering today is another worthy endeavor to fully understand the Foreign Account Tax Compliance Act because we are all facing an extraordinary requirement. By the way, portion of the speech I took from the speech made by BAP President Lorenzo in the last session that we had on FATCA sponsored by BAP and ASEAN Banking Council. The Foreign Account Tax Compliance Act, or FATCA, is a law of the United States. It has something to do with the tax efforts of an American government agency, the Internal Revenue Service, or the IRS. It applies to so-called US specified persons and not citizens of the Philippines. Strictly speaking, this is a purely American enterprise. Yet, we are all here gathered today expecting to learn and gear up ourselves for the law's eventual implementation. We are left with no choice. Non-compliance means the imposition of US withholding tax on all bank transactions that crosses the US border either way. The policy is intended to run after US tax evaders, but we will be at the receiving end if these same US persons are determined to evade the payment of taxes. We need to learn how to cut them and cut cleanly. How do we find these US persons among our list of clients and customers? Is our anti-money laundering automated system capable enough to do the job? Thus, our seminar today is very critical. A half-day seminar is not sufficient, but we will try our best. There are still issues to be resolved, such as whether to go directly to the IRS or to do it through our own BIR. But the basic premise is already very clear to all. FATCA is an extensive new reporting and withholding requirements intended to prevent tax evasion by US persons. Wishing us all a successful seminar. Magandang umaga po uli sa inyong lahat. Thank you very much.